Well, good morning, good afternoon, good evening around the world. My name is Doug Brunke, and I will show you that I am here. However, I'm in a little bit of a rough Wi-Fi area, so I'm going to keep my video off. Fortunately for all of us, perhaps, I will not be speaking for very long today, other than to say I'm really excited by this program and this series that really Dwight and the Global Chamber Chicago chapter has put together on financing. This is such an important topic and it's so little known by exporters. It's certainly one of the barriers to exporting and why less than 1 in 100 companies in the US export. And of those, less than 50% export to another country besides Mexico and Canada. That's a lot of the reason why I am the founder of Global Chamber, because it's frustrated me as a member of the District Export Council that so few companies think of the world where 85% of business happens as something they can go after. And part of that reason certainly is logistics and intellectual property and financing. And so we're going to be talking about financing with three experts today, and I'll include Dwight as a fourth. Dwight Winkler is a member, lived in Nigeria, in Kuwait, and Indonesia for extended periods of time in each case. He now happens to live in the US and he's part of our Global Chamber Chicago Advisory Board. And he's been somewhat the not only the brainchild, but also someone who has helped facilitate this session all along the way. And when I say session, I mean this is the second of a series. I think possibly because of, I know Ling also was going to be here today and she's not yet. It may be hopefully not a time zone change issue. I know those of us who have spent some time in Arizona, which does not have daylight savings time, although I spend most of my time now in California, which does have daylight savings time, it's very easy to get confused. And when you think about the world where UK does, although at a different schedule, but Japan and South Korea do not. I don't think South Korea does. And on a global scale, wouldn't it be cool if we didn't have daylight savings time? There's enough confusion in the world. But nonetheless, at least over the next hour, we're going to have export credit financing and financing your exports a little bit better understood. So I'd like to turn over the program to Dwight Winkler. Dwight, thank you for your leadership. Thank you for your knowledge. Thank you for pulling the series together. Over to you, sir.
Thank you, Doug. Pleasure to be here and a pleasure to have had the opportunity to put this together. I think we talk about, global sales growing the revenue line for companies, whether it's export or import. Well, to do that, you have to deal with your commercial terms and conditions. People want to get paid. They either want to get paid, in advance. They either want to get paid on delivery, or they are some type of deferred payment structure. But no matter what, whether it's a service or a piece of infrastructure equipment, you name it, and like I said, it doesn't matter whether you're buying or selling, export or import. It all boils down to what are the commercial terms under which you are underwriting that particular sales transaction. And to do that, you need risk mitigants, especially if you're going cross-border trade, and you need to draw on those resources to do that. And so I think, this is an excellent opportunity. We've had, this is the second of a 4-part series. Part one, which we did back in September, we covered the trade insurance arena, and we covered commercial banking as well as some fintech. And this session here, we're now getting into the sort of the credit reporting, what I would look at as the the really due diligence. That's where you start. You got to do your due diligence in that on who you're selling to or who you're buying from, who do you want to work with. And so you need to reach out to outside parties, and CreditSafe is one of them. They're on our panel here today, that you can reach out to go to work and do that. And once you've established and feel that you've got an arrangement that you can go forward with, then you can start talking about the other types of financing structures, whether short-term or medium-term, however you want to do it. in that moving forward. So, what we're going to do for parts 3 and 4 early in the new year, we haven't quite decided yet. We'll get to that when we get closer to it. But for today, let's move on with the excellent panelists that we have here today. And I'd like to, at this point, call on Bill from Credit Safe. Bill is the enterprise sales director for the company, and Credit Safe is a company you can go to if you need to get a credit report or credit information on a buyer or an importer or a supplier, whoever you wanted to deal with overseas. So over to you, Bill.
Thanks, Dwight. Appreciate the time today. And I should have sharpened up on some of my opening act jokes to kind of get everyone engaged here, especially after lunch for those of you who are in Central and Eastern time. But again, just want to thank everyone for taking some time to learn a little bit more about navigating some of the risks of doing business internationally. A little bit about myself. I am the Director of Enterprise Sales and Strategy for Credit Safe USA. I've been with them for about 2 years now. Prior, I spent 7 years at Dun & Bradstreet as the Vice President of Third-Party Risk Management and also Finance Solutions, and spent some time at some startup data and analytics companies as well. So I have a background in finance. I don't necessarily know how I ended up in risk mitigation, but here we are, and I absolutely love what we do. But so what I want to kind of walk you guys through today is, what do you do on the front end? Okay, so as Dwight mentioned, how do we know that we're going to be getting into business with the right, actors? There's good actors and there's bad actors. So how do we sort those bad actors out from what we're doing? So I'm going to share my screen here. So give me 1 second. Show all windows. Here we go. And then just let me know when you guys can see my screen here.
I can see it.
Oh, good. Okay. So again, up front, what are the rewards of doing business internationally? I think Dwight did a great job of kind of giving a very high level summary of why companies are interested in doing this. Being able to expand your target markets, right? So how do we take our business outside of the domestic footprint? Obviously, increasing revenue is always of top of mind when companies look to expand globally. But then, there's additional risks that need to be paid attention to in return for that increased revenue. From a vendor or supplier standpoint, there's additional cost savings that could be had by the business, depending on geographic regions where you are leveraging certain suppliers and vendors for your goods and or services. How can you create a competitive advantage, right? So as we all try to gain market share in our particular industries, what can we do different to set us apart from our competitors? How do we gain that one leg up? Diversification, right? So less dependent on a single market. It's turbulent times here. I'll use the auto industry as an example. Here in the US, we currently have a strike going on in the auto industry, and there's a lot of parts that are on back order, right? So what are we doing to make ourselves less dependent on a particular geographic region? You'll actually be able to reduce your risk, especially from a supply chain perspective, when you spread out your vendors across multiple geographies, right? So I think a lot of us saw this during COVID, and a lot of companies were, scrambling. What can we do to help diversify the location of some of our suppliers? Access to export financing, right? So additional benefits from a financing perspective, which the next two panelists who will come after me are much more qualified to speak to on that. And then access to global talent, right? So being able to access at some point deeply discounted, very talented individuals, depending on which market you're growing into. So while all that might sound great and easy, there's a lot of things that we need to navigate when we do this, okay? So this is some of the font might be a little bit small on here, but really quickly, what are some things we need to pay attention to? Obviously, regulatory issues and laws are different by country. So, globally, we need to pay attention to, the regulatory networks and sanctions lists, right? So you can see here, 78% of companies' operations are affected by regulatory networks and sanctions, right? And that's provided by LexisNexis. There's been a huge magnifying glass and increased efforts to limit forced labor and child slave labor across the world, especially in the manufacturing space. So depending on what industry you're in, how are you screening for that? To making sure that you're complying with all local regulatory issues that could be affecting your business. So financial crime and compliance, right, absolutely has skyrocketed, especially since the global pandemic. So you can see here again, reported from LexisNexis, $206.1 billion globally of financial crime, right? So anti-money laundering, making sure that we're dealing with individuals who are who they say they are. We saw, again, in those dollars, we saw a 50% spike in money laundering. That's based from the Financial Times, okay? And then growing regulatory pressure to prevent child labor and forced labor inside of supply chains. One thing that's not on here is, as part of that is the reputational risk that one could encounter by doing business with someone who may use child labor or forced labor. On top of that, sorry, got a little click happy there. On top of that, we have to worry about our own data when we're making these decisions and navigating, these international waters. So whatever system, teams of individuals are using to do their due diligence, whether in a supply chain or vendor assurance, vendor management platform, a GRC platform, or on the finance side, you have to ensure that your data is top notch, up to date, and accurate. Okay, so Kissmetrics released an article not too long ago that 20% of revenue is lost due to bad data. Right? I mean, that's when you're getting into the couple $100 million to multi-billion-dollar entities, that adds up really, really quickly. Right? Gartner put out another study that says B2B business data decays at a rate of 70% per year. Okay, this is business name changes, right? Addresses, phone numbers, websites, directors. All this data is constantly changing and evolving, 5 to 6% per month. How are we staying on top of that? What strategies are we doing, to make sure that our data is staying up to date and clean? And then as part of that same study, bad data costs businesses up to $15 million per year, right? We recently, as a company, CreditSafe, put out a survey that we entitled Sales versus Credit Control, right? Because a personal mission of mine is to always create a great synergy between sales and finance, right? So sales is always looking at finance as a barrier to their sales or their commission, right? Why can't we extend terms to this customer? They're good. I know John over there for 15 years, right? Well, let's back up these decisions with data, right? So there's a lot of science that goes into these decision making as well as gut feeling. But only 30% of businesses rate the customer data as excellent. Okay, so that leaves a whole lot of room for improvement, right? So having some sort of master data management strategy or some sort of data steward in-house to help come up with a plan to keep data up to par. Now, let's talk about credit policies, right? So when I interact with companies and at CreditSafe, we work with small mom and pop shops all the way up to Fortune 500 companies. And I'll ask everyone the same thing is, when was the last time you updated your credit policy? And I'm shocked sometimes at the length of time it's been since companies have updated their credit policy. So even from a synergistic standpoint, your credit policy should reflect almost what your company growth objectives are. If you have extremely aggressive growth objectives, then you're probably willing to take on a little bit more risk. So maybe you want to make sure that your credit policy reflects that. Again, if it's more of a conservative growth attainment number or growth number that you're looking to attain, then maybe you put a bit of a stricter credit policy into effect, right? But there's a big lack of communication between, stakeholders internally when it comes to the credit policy and what it can do, right? So sales professionals have little to no understanding of the company's credit policy. 42% of them, as a matter of fact, when petitioned. And again, this is based on Credit Safe's sales versus credit control research study. Okay. Sales professionals have up to 10 deals rejected each month. Okay. There's plenty of studies that are out there. If you're putting customers on cash in advance because of lack of a solid foundational process from a credit perspective, a customer that you can put on terms will spend 60% more revenue with you than they would a vendor that is making them pay cash in advance. Okay. Sales professionals are still pursuing leads that are habitual late payers and have poor credit scores, right? So this is where the collaboration between finance and sales, would come in handy. So instead of salespeople wasting their time talking to unqualified prospects, again, this is all from a B2B perspective, why not have some sort of tool or policy procedures in place where we're going to look at pre-qualified prospects for our sales team? We know they're going to meet approval standards because of the communication that we have between sales and between finance. And then lastly, sales professionals lose up to $200,000 a month in deals because they didn't meet the minimum credit standards to receive terms, right? So it's very easy to see how that can add up very quickly. If you extrapolate that number out times the number of sales professionals in your organization times 12 months, we're potentially leaving a lot of money on the table. Okay. So how do we create an effective credit policy, right? So first and foremost, as an organization, and this comes from the top down, is what type of risk are we willing to accept in pursuit of this revenue? Okay. So having this communication, having some sort of committee or panel that is going to come up with, a common goal and common parameters for that, right? So set the parameters for how much revenue you're comfortable having outstanding at any given time. You can come up with a percentage, you can come up with a dollar amount. It's completely up to the individual organization, right? And just outside of providing commercial credit data and compliance information to our customers, we help them do things like this as well. Then we need to identify the ideal credit applicants. Who do we want to pursue, right? Who are our best paying customers today? If I could mirror my top 10 best paying customers, what would that do for my business, right? So having some sort of tool in place to go after those customers that look exactly like your best customers, okay? And then setting the correct payment terms. Is net 30 best for your business, net 15, net 45, net 60? We don't know. Again, that's for you to determine what works best for your business. Again, this is going to come into managing cash flow. How often do you want this cash to come in? And the answer is usually as quick as possible. And then having the collections process in place. What is that going to look like? Even today with all the automation tools that are available to companies that are out there, 75% at least of the businesses that I interact with are still very reactive from a collections process. Once the invoice goes late, now they're involved, right? So what type of proactive steps can we take in the collections process to ensure that we're going to receive timely payment? Okay. And then again, upon final setup, you want to communicate this out. what does this process look like? What's this procedure look like? And who should we internally communicate this out to? Okay. Couple scenarios of potential customers that are in high risk. A couple things we look at: high debt, high credit usage imbalances, right? So if there's a lot of existing debt already, and you could see high credit balances and low credit limits available, profits on the decline, that's a potential red flag, right? You want to dive into that and take a deeper look into the details of what's going on with that particular company. Scenario 2, DBT, guys, stands for days beyond terms. So that's one of the metrics that we track at CreditSafe, is how a company is paying their bills. So 25 days and above is really high, right? So most of the times it's based around net 30 terms. So they're essentially paying you every other cycle, okay? Or if we've seen days beyond terms increase drastically over a short period of time, our trade payment data is updated on a weekly basis. So this stuff moves pretty quickly, right? So drastic increases, stays there for an increased period of time, and you can see the percentage of past due payments starting to creep up, and or high dollar amounts that are overdue. Okay. Legal filings is something that is a little bit underrated as far as something that gets paid attention to, right? So making sure legal filings at a company aren't out of control or aren't too large, that could potentially cripple them paying you on time. And then again, total liabilities increasing consistently for over a 2-year period. Total working capital is decreasing consistently for 2 years. High credit usages, high days beyond terms compared to their peers in the same industry, right? All of this stuff should factor into the decision on whether or not to extend terms to that customer. We've done a good job of being able to accurately predict about 70% of the insolvencies over the last 3 years, based on some of our predictive risk metrics. But these are some of the things that would play into that. Now, on top of the finance and credit, when you do business internationally, you want to pay attention to other factors from a compliance standpoint: anti-money laundering, regulatory issues, sanctions, state-owned entities, PEP checks, right? So you're going to run a credit check on these international companies, right? You're going to make sure that you openly communicate your policy to them and when things are done, when they're due. As best you can, you would want to automate all of this, right? So especially for those of you who are in hyper growth mode, you're working with lots of different, customers and vendors. Allow your analysts, your collectors to spend the time on the entities and the records that need the time, right? A lot of this could be automated. Get real-time monitoring, guys, both from a financial and credit standpoint and a compliance standpoint. I can't stress this enough when I work with companies, is if you're not monitoring your existing portfolio of clients or the key high-risk essential vendors in your supply chain, then there's a huge gap in your process, right? So make sure you have 24/7 monitoring on those types of companies that you're working with. And then also make sure you have some sort of ongoing strategy for cleaning up your data, okay? You want to run, KYC and identification checks, especially internationally. There's plenty of tools for that. So you can safeguard from money laundering and siphon out those bad actors, right? I can tell you guys, in the marketplace, whether it's CreditSafe or D&B or Experian or any of the other providers that are out there and available to all of you, the cost to implement a solution where you can run all of these types of checks is pennies on the dollar compared to the potential fines that are levied if you're not doing your due diligence and something happens. Okay. So I'll pause there, see if there's any questions that anyone has. Be more than happy to answer those.
So Bill, can exporters, people that want to avail of your service, can he address you as sort of on both a one-off basis, or do they need, or are there packages that they can go to work and enroll in that? And that, just to be brief with a question, so we can move on with the other
Sure.
panelists.
Yeah, there's multiple ways to engage with us, right? Most folks leverage a 12-month subscription plan, right? And we get them set up. You're not left on an island if you do business with us. You get a dedicated account manager who's basically an extension of your team, who will learn your preferences, your policies, and make recommendations based on that, on how to structure everything. But I thank you all for your time today. And Dwight, I'll hand it back over to you.
Okay, thanks, Bill, for your very informative presentation. And that I can only validate on that, having been an international credit manager, in that I've always strived to be not the order prevention department, but the ally of the sales guy. So that seemed to work for me. So without further ado, I'd like to move on with Keith Schlegel. He's Export Finance Manager for Illinois and Wisconsin at the Small Business Administration. So over to you, Keith.
Thanks. Thanks, Dwight. And just want to make sure you could see my screen.
I can see it.
Awesome. Thanks. Well, really appreciate Doug and Dwight for having myself here and the rest of the team. I myself am relatively new to the SBA. I've been here for about 3 months now, but I come from a quite extensive trade finance background. Prior to the SBA, I was with JP Morgan in a variety of roles, from supply chain finance to traditional trade, to working in the back office and in sales. So really kind of have a broad scope of experience there. But really, I think the main reason you want us here today is to talk about, as Bill alluded to, the kind of understanding your clients. My end kind of deals more with getting access to the finance and capital. So, small businesses, are the backbone of our economy, and global sales is just a great way to grow and scale for them. Obviously, there's opportunities out there in the international markets, and as Bill alluded to earlier, there's plenty of challenges as well. So really, at the SBA, in my particular area, Office of International Trade, we have several programs that allow these small businesses to get access to capital. And one thing I do want to point out, though, just to clear things up, we don't direct lend to small businesses. That's done through lenders, right? But we support those lenders, and then them giving the access to the capital. So sometimes that's misconstrued in the market, but definitely our programs are there to support these loans. For instance, I'll kind of go over some of those programs that we have right now. So one of the larger programs that we have to offer is the Export Working Capital Program. This allows for owners to apply for loans in advance of an export sale or contract, and it gives them pretty good flexibility as far as negotiating payment terms. It could support up to 90% guarantee on that loan, up to $5 million. And typically, the lines of credit are either kind of an asset-based borrowing, where the lender is looking at your monthly collateral and lending it based upon those assets, or it could be transaction based on export purchase orders and contracts. And another great use for the Export Working Capital Program is it can offer the issuance of standby letters of credit, which only have to be 25% collateralized. So that's another great use for that program. So as I mentioned, certain aspects of this particular program allow for a 9% advance rate on export sales and foreign accounts receivable, and up to 75% advance rates on export inventory. One caveat is, the collateral is supposed to be export related, and typically, along with other let's say you have terms with your buyers. Typically, the terms are supported by credit insurance or a letter of credit. In some cases, that's not needed when you have open account terms with buyers, but generally in those cases, there's a good case that particular buyer is a long-term client and has shown, has a proven track record. Next program is the Export Express. This is a smaller, kind of like a one-stop shop, several use type of a program. Maximum is $500,000. The 90% is guaranteed up to 350, and then there's a 75% guarantee between 350 and 500. Like I said, the Export Express can be used in a variety of ways. But some instances can be for equipment purchase, traditional working capital type aspects. But it's usually kind of like a quicker type program for those companies not needing larger financing options. And then lastly, the other program we have, as far as the sizable programs, is the international trade loan. Very similar to our 7A type program, for those who are familiar with some of the SBA programs. This also carries a 90% guarantee on loans up to $5 million, with a max guarantee of $4.5 million. And the ITL, international trade loan, typically used for real estate, equipment purchases, debt refinance, permanent working capital, and some other business acquisitions. And one aspect of the ITL is it needs to be used to expand your export business. And that could be, if you're starting off with zero export business and moving it to 1% of your business, we're not looking at very specifics when it comes to expansion, but, something like that would be considered expanding your export business. And with that, with the ITL, we require a business plan or a business export plan that'll kind of elaborate your entry into these markets and how that would kind of make you more competitive, in a sense, by expanding internationally. And one other program I thought I'd mention, not necessarily specific to the larger programs we have, is the State Trade Expansion Program. This is offered by your state. The STEP program, can be used in a variety of ways. It could be used to help educate yourself in exporting, participate in foreign trade missions, designed to help you market yourself, support website globalization. And, Ursula may mention something to this effect later related to credit insurance that the Exim Bank offers, but it also could help pay for some of those Exim fees. So, another great example of some of the tools that are out there for you as a small business to get access to help in expanding your global trade. I also listed here some contacts regionally. I myself, as Dwight mentioned, cover Illinois and Wisconsin, but we have export finance managers like myself nationally. So I could easily provide this deck to Dwight and Doug for you to share with the participants on this webinar. But yeah, so these are the programs we have available. Kind of high level going over this. So really, it would be very dependent on each client that we talk to. I think one of the important pieces to consider when looking for trade finance is establishing a relationship with a lender. A lot of people may already have that lending relationship established. However, we do offer a list of banks that we can introduce you to in the event you do not have a lender. I think one of the main things is if you have an opportunity and a good business plan in place, you've been in business for a year or not in all cases is that a requirement, but generally speaking, having been in business is helpful. Showing that you've, are on your way to being a profitable company, or have, a business plan in place to expand, those are all key elements to, really kind of building that lending relationship with a financial institution. So, we definitely could work with your lender, like I said, or introduce you to somebody, but essentially, each, we would need to understand where you're moving and to fit you into the right program. So I'll stop there right now, Dwight, and see if anyone has any questions. Else we can move forward with Ursula.
So really the best way to access your program would be for somebody, if I'm an exporter in the Illinois, Wisconsin area, is to essentially dial you up and try to, make contact with you and then take it from there in terms of whether I have a lender or if I don't, and that then you can help in that. But the starting point is just reaching out to you and then taking it from there.
Yeah, and there are many different scenarios where I've been reached out to, whether it's someone who's brand new to exporting or someone who is more seasoned, really kind of, has that business plan in place. There are various agencies out there, like the small business development centers that, kind of help foster along new exporters and creating that plan down to the, final stages where they're reaching out to myself or their lenders reaching out to me to help support a line of credit that they have, related to foreign collateral, foreign, receivables, to that such where, we're looking to see what program best suits that exporter to provide them, their access to capital.
Okay. All right. Well, I think we need to. Oh, sorry, Doug.
Yeah, the only other question I had, which I wanted to just clarify. So if somebody is either somewhere in the U.S. Other than Chicago area, and maybe you could talk a little bit about what area that you do cover, and then if they're from that outside that area, are you okay with having them contact you as a first point of contact? And if they're outside the U.S., that's a different story.
Yeah, look, at the end of the day, we're here to help the small business. If I'm talking to a business and they're located in California, I'll definitely, take the time to listen to, what their needs are, and then bring in my counterpart from California to work with them. Ultimately, we're going to ask very similar questions. We want to know if they have an established lending relationship, because, ultimately that's where it all gets started. Without a lender, like I said, the SBA does not direct lend for these export programs. So we would need to establish that relationship. And a lot of companies I work with, a lot of them, they're not all profitable. They're not, showing, it's not all in the black. So really, that doesn't necessarily impede us from moving forward. Every business has a justification for, their numbers, and perhaps, we just got through a pandemic, or there could be competitive reasons why they're not able to show the sales that they want. And there is a reason for them to deal internationally through exporting for them to grow their business. And those are great stories and causes for, a lender to kind of take, I don't want to say necessarily use the word risk, but take on that client to, help promote their growth. And, it's through the U.S. government that we help provide that guarantee to that lender to help support that transaction.
Awesome. Thank you very much. I actually just a week or so ago was with Pelson Lau at an event in Anaheim for mostly Korean companies landing, but it was for U.S. companies to connect up with them. And he's been such a great resource here on the West Coast. And I would say generally, in fact, very specifically, every person I've met with your expertise within the SBA, Keith, has been just so helpful and so positive. And so thank you for being that resource for folks.
Oh, you're welcome.
Okay, so I think we move on to Ursula. I'd like to introduce Ursula Vengzinovich, and that I hope I got that right, Ursula, and that she's Director of Central Region for the U.S. Export-Import Bank, and I'd like to turn it over to you to wrap us up.
Great. Thank you so much. Can you see my screen already?
Sure can.
Awesome. Awesome. Well, first of all, thank you so much to you, to Doug and to Dimitris for inviting us here today. My name is Ursula Vengzinovich, and I am with Ex-Im Bank, based in our Chicago office, and kind of handle the middle part of the country. And what I want to talk to you today about is an overview of our services. I'll share a story or two about customers that we're currently supporting, and hopefully that'll help you kind of apply that to your own business and see how we may be able to assist you. So really quick, for those of you who may not be familiar with Ex-Im Bank, we are an independent federal government agency. So oftentimes we kind of say we're the sister agency to the U.S. Department of Commerce. They're kind of the behemoth the trade, U.S. trade government agency that kind of leads the efforts and helps companies find buyers internationally. SBA is the go-to on working capital financing. And then typically we will then come in and talk to companies about, how are you going to get paid? And, essentially by your international customer, or how do we get access to financing for your international customer if they're purchasing large pieces of capital equipment and so forth. So we've been around, we're coming up on our 90th birthday, and we have colleagues all across the United States who really are in a business development role that kind of help companies who are interested in our services figure out, how best to work with us. We just like to talk about the fact that, oftentimes we make the front page of the paper and it tends to be on very large transactions. And that's great. Those support jobs. But we just want to stress the fact that we, on a day-to-day basis, really work with small and mid-sized companies. So ideally, we're looking for companies who've been in business for at least 3 years. There's always, of course, exceptions to that. And I mean, in business, in general, not necessarily in exporting. And what we'll talk about is really kind of how we try to fill in the gap. So I think I heard that on your first session, you've already heard about trade credit insurance. And so we'll talk about essentially Ex-Im Bank, how we provide trade credit insurance. So I should have mentioned in my introduction that I've been with the bank for a total of 10 years. I started my career here in the late 90s and was here till early 2000s. And then I came back in 2020. And in a 15-year gap that I was not working for Ex-Im Bank, most of the time I worked as a trade credit insurance broker. So if you've heard about trade credit insurance already, you've probably heard about a broker or heard from a broker. Just like you might have a property and casualty broker that helps you get building owners, insurance policy or key man insurance or whatever type of insurance policy that you need for the assets of your business. Trade credit insurance brokers specifically work in this space. And that's what I did, working with companies to kind of figure out, is a alliance or some other private company going to be the best resource? And then US Ex-Im Bank is essentially the government insurance carrier. So that's what we'll talk about mostly this afternoon. So there's really kind of three, I'll maybe say now a little bit fourth ways that we work with companies. One is it's on that trade credit side, is making sure that companies have access to accounts receivable insurance, specifically for foreign. And we'll go through that a little bit more specifically. We kind of piggyback on SBA. When SBA hits their limit of $5 million on working capital support, we could kind of come in above that level. And then, as I mentioned in the beginning, a lot of what we do is make sure that if you are a seller of capital equipment in particular, and you're selling to an end user internationally, and that customer says, I'm really interested in this bottling line that you're offering or whatever it is that you're making, but we'd like to lease it from you. Or is there a way that, we can spread the payments? Oftentimes, this is something that we potentially can come in and we don't do leasing, but we can offer financing, which is potentially one step better. We'll talk about that. And I have to say, I am a fan of questions. So if anyone wants to come off mute in the midst of the presentation, please do. Feel free to do so. I threw up here what we call our country limitation schedule, possibly not the best branded name, but it essentially is a schedule of all the countries in the world, and it indicates whether or not we're open for doing business in that particular market or whether we're closed. The link is here at the bottom, and I'll be sure to share the slides as well. And this gets updated. Actually, I think we have a new one coming out just today. And when you click on that link to show whether or not we're open for business or not open for business, that's that's kind of the key to what Ex-Im Bank does. We're doing risk assessment. So when we work with US companies and we're talking about how are you going to get paid internationally, we're really looking at the credit risk of the buyer that you're dealing with, but also the country risk where you're doing business. So this is oftentimes a great resource. If you get inquiries via the internet or however they come in, to kind of check, is this a market that Ex-Im Bank is currently, doing business in? And when you click on a particular market, we divide a country sort of into two categories. Are we open in the public sector, meaning do we deal with foreign governments who might be the payers, or are we open in the private sector? So that's essentially an entity that's not owned by the government. Could be publicly traded company, but just essentially not owned by the government. And that is sort of, then the schedule kind of shows you either yes or no, we're open for business, or we're not over certain periods of time. So just pick, I hate to pick on Argentina, but as an example of, unfortunately, a market that we're currently not doing business in. So if you had an inquiry, you would know that at least, open account in Argentina with Ex-Im Bank backing is not going to happen, at the moment. So moving on to kind of the product that most of the customers that we deal with utilize. So while we did about $8.7 billion in authorizations, the vast majority of our volume is really in accounts receivable insurance, and we specifically do it only with foreign accounts. We heard earlier, and Bill did a great overview earlier, but essentially you want to be able to be in a position to offer open account terms. What we like to say is we talk to US companies, we say, don't say no, say maybe. The whole purpose of this insurance policy is that, as a business, when you look at your balance sheet, so many items in your balance sheet are insured, with the exception typically of accounts receivable insurance. Those tend not to be insured. And what an insurance policy can do is really threefold for you. It can give you that confidence if you have a creditworthy customer on the other end of the transaction to go ahead and give them those open account terms that the customer might be asking for. And then, of course, give you some comfort that you have a secondary source of repayment in case something goes sideways and your customer can't pay you. And then a lot of times companies end up coming to us because their banker has referred them, because they've already been doing open account sales with the distributor, somebody they met at a trade show, they established a relationship, they're doing it already. But those uninsured foreign receivables are not collateral that the bank could wrap their heads around and include in a borrowing base for a US company until and unless there's insurance on that. And so it's really kind of a threefold win for you as the company, because it hopefully can give you confidence in giving terms internationally, and at the same time help you sleep at night knowing, again, that you can get paid back, and then actually now use that insured receivable as additional collateral that you wouldn't have had before.
Is there an opportunity, Ursula, in that, these I'm sure can be done one-off on a case-by-case basis, or
exactly.
if there's a flow from an exporter, I'm assuming you still have your master policy type programs?
Exactly.
Where
yes.
The exporter, if he's doing a volume in various countries around the world, he can bundle that under I'm assuming you still apply the whole turnover requirement.
So actually, I would say we have three different ways that we can issue an insurance policy. Some companies come to us and say, I only want help with this one new distributor I have, because these other 10 that I have, I've been doing business with them a long time. I feel very comfortable, but I only want coverage on this one particular new customer. And we can do that. And there, the rates, because all of our eggs are in one basket, the rates are going to be a little bit all over the map. But just to give you an example in terms of cost, most of the time it's going to range the cost of the insurance anywhere from like 0.5% up to 1.5%, because it's going to depend. Are you giving 60-day terms? Are you giving 120-day terms? Are you selling to Vietnam? Are you selling to Mexico or Canada? So all those factors are taken into consideration, but our rates are actually available on our website, so they're easily accessible. So that's one option. The other end of the extreme is we have companies who come to us and say, I'm not interested in taking any international risk. If I'm giving credit internationally, I want coverage on those receivables, all of them. I'm not taking any risk. And so we can put in place sort of an umbrella policy for a company, and then each of the foreign customers are essentially endorsed to that policy. A few years ago, Ex-Im wanted to become a little bit more flexible, and so now we sort of offer a hybrid. So oftentimes we will work So we'll have companies who come to us and say, you know, I supplied John Deere and Cat here in the United States, and now they're having me ship their product overseas to their overseas locations, but we don't want to insure those sales because they're multinational. We have leverage, you know, through our US relationship. We think we're going to get paid on those receivables, but we've now entered India and China and these other markets, and we see that there are local companies that we can also be selling to, but those are the ones that we want coverage on, so that we can do sort of a hybrid. You can come to us and say, you know, here are the multinationals, we're good with those, we don't want coverage on those. Or maybe there's a region of the world, like maybe you say, you know what, I'm good in Western Europe, for example. That's a part of the world that I don't want any coverage, but you're going to provide me coverage everywhere else. Or I have a customer, anybody that I've been dealing with for 15 years and longer, I don't want coverage on that. I just want you to give me coverage on somebody who's, you know, newer, you know, 5 years or longer, whatever that parameter is. We can really establish kind of whatever the US company is interested. Of course, the more you select, the narrower scope of coverage that you provide to us, the more risk sharing that you do, because this is, you know, indeed an insurance policy.
You want a blended risk, and that's some good, some AAA
right,
along with the less than.
Exactly.
So
right.
You still have the discretionary credit limit feature?
Yes, we do. So for companies who set up more than just one insurance policy for one particular customer, oftentimes companies already have credit experience, and we don't necessarily want each foreign company to our underwriters to take a look at. Like if you already, as a US company, have experience, then we typically will give you authority to make credit decisions internally, either based on your own past history, or if you haven't had recent history with a given company, we kind of give you parameters. Like, you know, oftentimes it aligns with whatever the credit policy that you have as a company. And to Bill's comments earlier, great idea, one, to have a credit policy, and two, to update it periodically. And a lot of times companies will use sort of our parameters to help establish, you know, what does that credit policy look like? So I'll just go on here. What is covered specifically by the insurance policy is two major risk categories. It's political risk, it's commercial risk. Political risk is really in the action on the part of the foreign government, but that would prevent your foreign customer from making payment to you. So they can't convert their local currency to US dollar in order to remit payment to you, you know, certainly war, insurrection, anything like that. The other side of the coin is commercial risk, bankruptcy, insolvency, slow pay. You're selling to a distributor, that distributor is selling to an end user, the end user didn't pay the distributor. Oftentimes it's a domino effect. Now you're not getting paid as the supplier. And I will say that having worked as a broker and certainly being back at Ex-Im Bank as the insurance carrier, I would say 95% of the claims that we see are really just slow pay. They're just slow pay. It's not political risk. It's not bankruptcy. It's your customers robbing Peter, paid Paul. They're trying to move funds around. And I will say that having credit insurance oftentimes will prioritize which invoices foreign companies pay. So oftentimes we've heard from some of our customers that they will mention the fact that they might have to file a claim, and all of a sudden they never had to file a claim because they got their invoice paid. But that's kind of anecdotal. I'm not sure that I'm going to skip over the example just in the interest of time. I put up a slide here to kind of show if it is a slow pay situation, the fact that there is a bit of a waiting period before we actually pay a claim. So you, let's say, have a policy with us. You're insuring all of your foreign accounts receivable. You have a $20,000 invoice on net 60-day terms. It's going to cost you $110 to insure that $20,000 invoice. And in case your customer doesn't pay you, you will go through a claim filing process with us and we'll pay you back $19,000. So roughly 95%, assuming covering all of your international receivables. There is a waiting period though. It is 90 days past due. But essentially you're waiting to your customers at least 90 days past due before you file a claim with us. And the reason why is we want to give you time to attempt that collection. And then your claim filing window stays open for a period of 5 months. Why does it stay open that long? Well, again, we don't want to force you into a claim situation. We want to give you flexibility to decide. Maybe there was a natural disaster. Maybe your customer has a valid reason for why they're not paying. And if they're communicating with you, that is your decision to wait how long. But at one point in time, at essentially 8 months past due, we put our foot in the ground like, okay, the longer it's out there, the harder it is for us to collect. And anything that you file a claim with us, we then do go after the buyer in their local court of law to try to collect back from them. Which brings me nicely to kind of what are the documents that are good practice for you to keep copies of. And we don't have the time necessarily to delve in deep, but just from past experience, a purchase order written would be ideal. I've walked into companies in a lumber company, I remember in Sparta, Wisconsin, that was taking phone orders, and, that's okay. But documenting an order would be ideal. So whether it's a pro forma invoice that you generate and your customer signs off via email or whatever manner, but essentially you want them on the hook for having ordered the goods. Your final invoice, ideally you're moving the goods yourself, meaning you are hiring a forwarder to move the goods overseas. In our world, a bill of lading is something that's needed for claim filing. So we do get a little nervous when we talk to companies who are on an Ex Works basis, meaning you're not handling any of the freight movement. Your customer said they're going to send their routed forwarder to your door and pick up the goods. There's ways around that potentially, but bottom line is we do need a copy of that bill of lading in order to pay a claim. I'm going to skip on here because I know we're running a little bit short on time. So I'd mentioned here from our perspective, C or D terms from an Incoterms perspective are ideal because then we know you / your forwarder control that key bill of lading document for claim filing. If your customer is, 90, 120 days late and they're communicating with you and you're waiting on that claim payment, we just always say, don't reschedule any debt, like stick with the original due date. If they have a valid reason for paying late, just come back to us and say, hey, here's the reason. Give us a story. Our underwriters are great and flexible because, if we really can get you paid directly by your customer, that means we're not paying a claim. So that's better for everybody. I'm going to skip the working capital. This is essentially a very similar program to SBA. Keith's your guy up to 5 million. Ultimately, the bank that you're working with is going to decide, who's the better government agency to work with directly. And then I wanted to mention again that we do capital equipment financing. So again, another type of an insurance or a guarantee product where you're selling capital equipment, you have a foreign end user who's actually going to own that equipment coming to you and saying, hey, we'd like to lease. That's usually a good indication that they're looking for a way to spread their payments. So here what we do is we would require your end customer to provide you at least a 15% down payment, and then provided the remainder of that equipment is all US made, we'll find a bank. Let's say it's $1 million order you got, we'll find a bank to actually make that loan to your customer in Dubai or Brazil or wherever they're located. And the reason the bank's going to do that is they're going to have 100% coverage from Ex-Im Bank. They're not going to have any risk in the transaction. They're just a vehicle for us and to make that loan to your customer. You as a seller are paid at time of shipment. Once you present that bill of lading document and you're out, you've got a cash sale. Your customer's got potentially up 5-7 years, maybe even longer, depending on the size of the transaction, to repay for their equipment. So it's really a win-win situation. And the last thing I'll mention in my last breath here is a new program Ex-Im started just over 1.5 years ago, where we're actually doing some domestic financing, not working capital, but more permanent. So companies who are looking to onshore production or are expanding an existing manufacturing facility, renovating an existing manufacturing facility. This is a space that we're getting into now. We're not competing at all with the banks, but we have noticed a pullback to a degree on commercial real estate financing and some of this type of financing. This is a field that we're starting to get into. We just closed our first transaction in the last month or so for a company out of the suburbs of Wisconsin, a new lab essentially that got built there using our financing. That was just about $5 million. Again, anything under 5, SBA best fit. We are doing it over. Our sort of catch on this program is that we're looking for companies who are going to eventually be exporting 15 to 25% of their overall revenues. So we're, I think Bill mentioned in the beginning how important it is to diversify your customer base. We are always talking to companies about the need and the importance of exporting because that helps you diversify. So if we're going to get into domestic financing, we also are looking for companies who are essentially diversifying their portfolio and still exporting. So I'm going to stop there. Record time, sorry, for this quick overview.
Oh, understand.
Beautiful. Dwight, did you have any response to not only Ursula's conversation, but more holistically what we learned today?
Well, I think that this really provides almost an end-to-end view as to what one has to look at in putting an export sale together, notwithstanding whatever the size is. I mean, I for one, this was all very reminiscent for me, having been a global international credit manager for some major U.S. corporates, in that where you used the tools from Bill and then moving on with what Keith is offering, and obviously certainly Ursula, and pulling these all together, and that's where you need people that can tie all of those threads into one place. But it certainly is a path to growing export revenues and mitigating the risks at the same time. So this was all extremely informative, and we will certainly use this material to get out further to our membership in the Global Chamber.
Fantastic. Yeah, if you're watching this as a video recording, it's going to be on our blog around noon, November, the middle of November of 2023. And I agree with you. This is a kind of an end-to-end complete picture, nearly complete picture of certainly some key things to understand for exporting and increasing your exporting. Dwight, thank you for pulling us together. I don't think Dimitris was able to join us today, but Dimitris Evans is a very important trade attorney in the Chicago, Illinois, U.S. Market. She's our advisory board chair, and she, as an attorney, as all of us sometimes get pulled into things that that were unexpected. She really has some things because of working for clients that have her pulled away at times, and I think that's what happened for her today. So check out the blog post that'll be in mid-November of 2023. Check out the Global Chamber Chicago advisory board and chapter activities, and check out Global Chamber, period. Our thing and our uniqueness is that we are everywhere, not just the U.S., but certainly all across the U.S. And our focus is not just companies that are landing in the U.S., but actually we were formed to help exporters be more successful. And this topic is an essential one for exporters to be more successful. Thank you all for speaking today. Ursula, even though it was quick, it was complete. So thank you very much.
Right.
Keith, always outstanding to hear from the SBA, and you were great. And thank you, Bill, for all that you do at CreditSafe. And CreditSafe's risk mitigation is an essential part of the mixture. Thanks, everybody. Dwight, any final word before we close?
No, I think this was awesome, and stay tuned for parts 3 and 4.
Thank you.
Thanks, everyone. Bye.
Thank you.
Thank you all,
everybody. Take care.
Okay.
Bye-bye.
Take care. Bye.